I'm Joe. I'm the head of residential and student accommodation.
So I'm Samuel, CEO of Bonart.
Yes, good afternoon, Xavier Jongen.
Yeah, thank you. My name is Oremus.
Jongen, I'm director in the capital markets team.
Alan Chilten, Patrizia.
Trei is a shortcut of Tengelman Real Estate International.
Thank you everyone for joining the 2020 PropertyEU Residential Outlook discussion.
Yeah, well, it's explainable to some extent, obviously, because some of the good news that we just have been, reviewing the last half hour. I mean, it's part of that, right? There's a whole debate on resilience of resi, and that kind of drives that. To some extent, I think it's also perfectly rational. You can follow what's happening. Other asset classes are more hit also than residential, so there's always a little bit of a relative game as well in there. Having said this, we kind of should also look at some really strange things that are happening. So Gunnar's introductory point that actually prices on the investment market per square meter are sometimes higher than they are in the owner-occupier market. Now that's an interesting point, Gunnar, that you made. And I've observed that as well, right? So there's a Nobel Prize book that was written on that topic, and that kind of helped us to kind of see when resi prices are overheating. And at that point, it's Case and Schiller, by the way. So, and it's they wrote it at that point to show that owner-occupier markets can be overpriced, and they kind of related that to rental yield on the rental market. I think it's interesting for us to kind of stand still for a couple of seconds and realize that what Gunnar has said is the exact inverse of what Case Schiller got the Nobel Prize for. Because now we're making a case that the yield of an asset can result in a higher square meter price than an owner-occupier price, and we see some rationale in that. Now, what is a sensible price point for the assets that we're buying? And some of the metrics that we're kind of used at looking for and pricing assets with, like over 10 years, they are not, but they are showing very strange signals at the moment. So, how do we deal with that? What do we think about tipping points in the market? So I think specifically it's a bit when you raise it like new capital coming into the market. I think the new capital is often attracted by the sunny side story of resi, which is also there. So I agree with much that has been said. But once the capital is there, we'll actually discover that resi is very cyclical, that it has quite a few risks, that you can make terrible investments. And I think we should all kind of, in an institutional world, make investors make the proper decisions.
Yeah, I tend to agree with Xavier in terms of his point that the increased demand from international institutional investors is not only real estate investors. We are seeing bond investors looking at the real estate space in terms of the similarities between the residential income and the bond income that they search for and yield they search for. So for us, it's very key to have those specialists on the ground. And I think over the last 36 years, as Xavier alluded to, we've made mistakes that new managers and new sources of capital going into residential for the first time right now, could make the similar mistakes to what we've made previously. So we rely very heavily on big data and the people on the ground, and we think it's that combination of the two that really tries to identify these micro areas and then the relevant property strategy to fit that micro area in the community. And the community is the key part. You need to be adding value to the community via the property type that you are managing there. Not only from the real estate point of view, but obviously the social well-being, inclusion, diversity point of view that is obviously a hot topic with investors as well at the moment.
Yeah, what hasn't been mentioned that many investors do have retail allocations. Obviously, that's more difficult than it was in the past. You see that many investors are on pause if they're talking about other commercial, especially offices. So I think residential also seem more or less to be the safe haven for many investors looking for a little bit return. As said before, the low bond yields are also not a safe haven anymore. In fact, that could be a negative safe haven. So the interest rates are really a big driver behind the current resi market pricing. I would, however, like to repeat that the imbalance in supply demand is also fundamental. So it's the combination between imbalance and long interest rates which has brought us where we are today.
Retail in Poland is already present for some 20 few years probably, while residential in this institutional form, I would say, is still not present there. So our effort is not to switch from, for instance, office investment into housing opposite. We are more trying to attract investors to come to Poland at all. We of course know that Poland is much more risky place for investments from point of view of foreign investors. That's why we have to give in return much higher yields. And this is what's working very well with retail just now. It's not a big problem to have initial yields in Poland still around 8-9%. And this is of course something you don't remember in your countries for many years. And by that factor, we are able to attract family money and soon I think also institutional money in retail successfully already now. And in this PRS sector, we hope to do in coming year. So instead of high competition on the market, we have a problem of safety of investments.